Good morning, everyone. Welcome to the No Interest Loan Scheme pilot webinar. Thank you for joining us. We were delighted at the attendance that we had at the first session where we covered the strategy, rationale for the pilot. We heard from Minister John Glenn and covered a little bit more of the detail of the structure. This morning we're going to be covering procurement, contracting, co-funding, pricing and delivery. And before we start, I'd just like to introduce the team. So I'm Kate Pender, I'm the Director of Growth and Development Programs at Fair for All Finance, and I'm really pleased to be here today with my colleagues.
Hi, I'm Carl Packman, I'm from Fair by Design, and I'm involved in the NILS pilot because testing ways to reduce the access to affordable credit and low-cost credit is an important part of reducing the poverty premium.
Hi, I'm Sian Williams from the charity Toynbee Hall in London's East End, and we see on the front line how not having access to affordable credit can really hold people back and create worse financial circumstances. So we're excited to be involved in the pilot.
Hi, I'm Lauren Peel. I work at Fair for All Finance as Head of Markets, Consumer Insights and Product Design, and excited to be leading the product design workstream for the No Interest Loan Scheme.
Hi everyone, I'm Georgia Cooley and I'm a Programme Manager at Fair for All Finance, and I've been working with the team to coordinate the planning and delivery for the pilot and really looking forward to getting it underway and testing what the benefits might be for customers in vulnerable circumstances.
Hi, it's good to see everyone. My name is Tom Lake. I'm Director of Strategy and Policy at Fair for All Finance, and I'm particularly thinking about the partnership element of the NILS scheme to enable delivery.
Good morning, my name is Gary Stevens and I'm supporting Fair for All Finance with the procurement process. Thank you.
Thanks everyone. So just to give you a sense of what we're going to cover today, first of all, we're going to give you an overview of what we want your input on ahead of us procuring the NILS pilot. So as we mentioned in the first webinar, we've got an initial design and some plans that we want to test with you, and that's really the purpose of these webinars. We'll also be issuing a market engagement pack to get your input on some key points, which my colleague's going to talk through shortly. And after today, we'll be sharing a full frequently asked questions summary of questions that arose in the last webinar and this one, along with that market engagement pack and a draft contract for your review. Also today, we're going to do a recap on NILS, talk about the pilot structure, the procurement, everyone's favourite topic, funding and fees, along with delivery phasing, the bid assessment criteria and contracting. So what do we want your input on?
Thanks, Kate. So yes, the webinar today kicks off our market engagement process, which is really exciting. We've been working on the plans for the pilot for a little while, and this is the point where we're bringing those plans to you in detail and asking and really hoping for your input and your expertise, particularly around what needs to be true for you and your organisation and your customers to make this scheme a real success. And that feedback is going to be so crucial to help us shape the scheme. So we really appreciate you kind of giving your time. So how will that work in kind of practice? So yeah, as Kate mentioned, we'll be sharing a really detailed market engagement pack, which will include some of the slides from today's webinar. So don't worry about taking notes. There's a lot on the slides, but you'll be receiving a copy. And that will cover everything from sort of customer journey and product design to the evaluation, procurement approach, contracting, pricing, you name it. And at the end of every section in that pack, you'll find a set of questions that we're hoping for your feedback on. So there's a link within that pack, and that will take you to an online form where you can answer the questions that are relevant to your organisation. And don't feel like you need to answer all of the questions. There are quite a lot of them. And yeah, we'd really love your feedback on that by the 18th of October. And that will just give us time to feed in any comments into the kind of procurement, which is going live in November. I think the second objective of the market engagement process that's just worth flagging is a kind of matchmaking of local partners. So if you're interested in bidding, it may be that you already have those kind of partnerships in place, which is brilliant. But if you don't, let us know on that same online form, and we can try and matchmake you with other local interested partners in your area. So now we're going to just do a quick recap of the scheme and the approach.
Thanks, Georgia. We'll just remind you, if you joined us before, and for those who are new, a few key elements. What are we trying to do and how are we trying to do it? So we're taking a place-based approach for the pilot. We think that communities know their residents best, and so we want to make sure that we've got a really deep knowledge of the area, and that's why we're taking a place-based approach. The range of loans, we're imagining something between, say, £100 and £2,000 to meet a range of needs, with an average loan size we've budgeted for of around £500. We're aiming at people who are currently excluded from accessing affordable credit, whether that's from mainstream or responsible lenders. We're not trying to replace products from credit unions and CDFIs. We're trying to help you meet the need that you can't currently meet. So we are working with regulated lenders, and that procurement process that Georgia's just outlined will be the start of engaging people for the pilot. And if you're a pilot lender, that doesn't preclude you from going on into the next part of the scaling up. And if you're not a pilot member, it's fine. You know, there'll be opportunities to get involved later. Although we are designing this centrally, we are designing it collaboratively, and we're trying to devolve as much of the decision making as possible. And so lenders will be responsible in the pilot for lending decisions to individuals. There'll be guidelines and a framework that we'll design together, and we've obviously done a lot of work on that already. But you will be, as a lender, making the decisions about who to lend within the parameters of the pilot. And the parameters are going to test variables, because we're trying to work out who does NEILS work for, if at all, how does it work for them best, and then how do we deliver that, and then finally, how do we scale it? And the last big question, of course, is it worth it? Is it the best use of funds to do it in this way? So let me take you through a little bit of the approach. Today we're sharing more information, and you'll receive the market engagement pack, and there'll be plenty of opportunities to ask more detailed questions. Your feedback, both from the last webinar and this one, and then from the market engagement process, will give us even more information about testing our pilot parameters and the assumptions that we've had to make to be able to design the pilot so far. We're also working with people with lived experience of being excluded from affordable credit to make sure that we're designing a product that works for the intended beneficiaries. The next stage is to procure the partnerships to deliver the pilot, and that's what this stage kicks off. So we're really excited that you're here, and please ask lots of We've got both an impact evaluation and a process evaluation, because we want to learn as we go. There's going to be iteration. So if you want to take part, please don't think that what you're going to be asked to do at the beginning is deliver something for 2 years, whether or not it's working with no changes. We're going to iterate as we go. And so we're looking for partners who are really up for testing something in the field and refining it together. And through all of that, what we hope that the evaluation will show us is that NEILS does or doesn't work, and it works under certain circumstances, and it works in particular ways of being delivered best, so that we can start to say either this didn't work for the UK, we need to put it to one side and move on to other things, or hopefully that we know how it works best and that we can start to put together plans for scaling up. Right now, we've just begun a proof of concept stage, because whilst we go through the procurement for the big NEILS pilot with those 5 or 6 target areas, actually we wanted to be learning already. So we've just procured a provider to work with us on a proof of concept, and we'll be sharing all of that information. And finally, we're going to work in about up to 6 locations in the UK. So please, it's all open, come and get involved. So let's look at the pilot setup timeline.
Okay, thank you, Sean. I'm going to discuss the pilot timeline now. There would normally be a slide, but for the active period of our organisations working on the background of NEILS, that will be between Q2 this year and Q2 of next year. So I'm going to run through a little bit about what we're going to be doing in between those times. Finalising the proof of concept for the no interest loan scheme and setting that up with participating suppliers in their participating areas. That work is already taking place and the work will feed into the main pilot next year. Market engagement, that is ongoing now, will run until the Q4 of this year. Product designs nearly spans the entirety of the working period for the early NILS process. That starts from next month right up until the end of the process, and it includes lived experience workshops with intended customers, and will be an iterative process to make sure that we get that right. So it's a really big chunk of time. The lender and co-funder procurement will take place between Q4 of this year, so this winter, right up until the middle of 2022, and we'll be issuing the tender for that around mid-November and appointing partners early next year. This will be followed by a period of mobilisation, setup and product design collaboration over the summer, with a view of getting the first loans out in September. Exciting. So I'll talk about who is eligible for the no interest loan scheme. It's important to recognise early on that this is the eligibility criteria is all subject to change. Eligibility is one of the main things being put through an iterative process, and a reason for why we want to go into the testing phase of the no interest loan scheme with an agile approach, because we want to get this right. So I'll describe the two main ways an individual will be eligible for NILS. An affordability decline, so on that there is 3 possible routes to accessing a no interest loan scheme. Someone that falls between below typical affordability criteria for that particular lender. Their credit need cannot be met by any other statutory payment, like a benefit payment, or would only be able to stay in budget on existing debts if they were to borrow a capital only loan, not an interest bearing loan. And the second one is lending criteria decline. On this, there are 2 possible routes to no interest loan scheme. Someone who fails a credit check, but the lender knows that this won't be an ongoing issue and has a poor record of repayment due to factors outside their control rather than an unwillingness to pay. Both main routes to being eligible could be either direct, say applying through a lender, the participating lender, or referred to by a partner organisation, like a housing association. So at this stage, we're going to move on to how affordability will be assessed.
Yeah, thanks, Carl. As both Carl and Sean have said, an eligible customer would be able to repay the capital, so an affordability assessment remains critical as part of the no interest loan scheme process. We'd expect lenders to use their existing good practices, such as income and expenditure assessments, open banking, credit reference checks for no interest loans to ensure they're right for the customer. We also know that repayment flexibility is really important to these customers, whether that's through payment holidays or a delayed repayment date, so kind of starting to repay later. And we're considering how repayment flexibility can be designed in from the outset to make sure the product suits customers' needs, and that's something that we're considering as part of this process. We're also thinking about scenarios where a borrower's circumstances and history might require a CDFI delivered loan, where the interest rate would usually be higher to reflect the risk, and where avoiding that interest will make a more significant difference to the affordability of the loan on the NILS scheme. As we've already said, product design is both an iterative and collaborative process, both through the market engagement process and working directly with lenders and hearing from customers. So much more to come on this. And now we'll talk about local integration with co-funders and referral partners to really talk about how we'll reach customers.
Thank you, Lauren. So as a couple of colleagues have said, the local delivery elements are a really important part of delivering NILS and making sure that NILS is appropriately integrated with local need, and then we've got the right channels there to reach customers and fulfill loans. So local integration is quite a big part of the scoring element to bids coming in, and we would like partnership bids. So clearly the lender is a really important part of this, and we'll do lots of the all of the loan fulfillment, but alongside that, we're seeking referral partners and funding partners into the scheme as well. So it's important for us to understand what kind of relevant complementary support is there locally, and there'll be a bidding assessment element to the strength and the partnership between the lender and any collaboration partners too. If we just jump to the next slide, we've had a few discussions with potential co-funders and also referral partners, and we know there are lots of both housing associations and local authorities on this call now, and we think that from those discussions, those types of organisations will be great at identifying customer need for a solution like a no interest loan scheme. So for a housing association, that could be a housing officer who sees financial difficulty, or a debt advisor in that housing association. At a local authority, we know there's often lines for resident hardship, and types of financial conversations are had there. We think that a nil scheme could be a really powerful addition to that suite of potential support products for customers. So we'd love housing associations and local authorities and any other organisations who can refer to lenders and can credit broker to kind of come forward to be delivery partners alongside lenders. And just on that last bullet point there, it's probably important to highlight that referrals into the no interest loan scheme will be credit brokering. We know that some organisation types have exemptions for credit brokering into certain lenders, and we also know that some organisations already have credit brokering licenses. So just to note there that one of those two things will be a requirement to be a referral partner into the scheme. And then if we just jump on again, so alongside referring into the scheme, again, this has come from discussions with these potential local partners. We think there's a case for kind of collaborating on co-funding with partners too, and we'd really like to do this because essentially NILS is expensive. We think it'll be really good for customers, but we know there's a heavy subsidy that's required to deliver it, and therefore we want to build the best possible funding collaboration early to get to the point where we can reach scaling. So we've had a couple of early conversations with local authorities and housing associations about this co-funding bit, to essentially come in and make NILS go further with funding from these local partners in addition to the government funding and the funding that Fair for All Finance is putting up. So we'll detail it out in the pack, but we basically encourage those partners referring into the scheme to also put up funding if they see the business case for that. We think there's a natural business case there and shared objectives around poverty alleviation and community building and building up fair financial services. At the same time, we've heard that there's a value for money payoff where, for example, if we take the case of a housing association, there is benefit to helping a customer with their financial well-being, because eventually that will mean that, will hopefully mean that they don't experience as much financial hardship, and they are more likely to stay in the tenancy. So there's a case on all sides there, and I think that's the case with local authorities too. So yeah, this bit's just been to emphasise that partnerships are really what we're going for in this delivery, and really compelling bids will have at least one organisation coming into them. So we'll talk a bit more now about how procurement will actually work for bidders.
Thanks, Tom. So we're obviously managing public money in this pilot, and as some of you will know, while that can necessitate quite comprehensive and potentially a fairly lengthy procurement process, we also want to make sure that the process is really open and transparent, and we're also being respectful of everyone's time. So I think that's kind of the first thing to say. We also really want to attract the right bids and the right partnerships, as Tom's just outlined, to make sure that the pilot's as successful as possible. So how will we make it really worthwhile for bidders? So I think there are kind of three key elements here to pull out, and we'll go into more detail in this session and in the slide pack that will be shared with you tomorrow. But I think the first one is really about contracts. So we've set those up hopefully to be as kind of as flexible as possible, and that's both in terms of being able to extend the length of the contract and also being able to extend the scope. And that could include potentially testing other products beyond nils in the future, which my colleague Lauren is going to talk to in a moment. The second kind of point to make is the fee structure, which hopefully we've set up to recognise and reflect the costs and the risk that the lender will take on as part of the nils pilot. And again, Kate's going to chat to that shortly. And I think the final point is really about procurement. So we've structured the procurement in lots, and that's to kind of create geographical flexibility, which we hope will make it really compelling to bid for, which actually takes us on to the next slide and how that kind of lot and procurement structure will work. So I think, as you know, we're delivering the pilot in up to 6 locations across all 4 nations in the UK. And that's 1 in each of Northern Ireland, Scotland and Wales, and up to 3 locations in England. So the lot structure means that bidders can opt to deliver more than just 1 location. And there are 8 lots in total, which you can see here, which include any combination of the single locations, all 3 England locations bundled together, and even all 6 locations in the UK. So we're aware that obviously credit unions, there needs to be alignment with the common bond, and I just wanted to kind of flag that that won't be a barrier to being selected in the procurement process. I know that was a question that came up in the last session. And it's just also worth noting that in each location, we're anticipating approximately about 3,000 loans over the whole pilot duration, so over that 2-year period. The final thing just to note, I think, on this is we're also considering an additional lot, which would cover all geographies and would be kind of focused on those smaller value loans, which might be kind of potentially most suited to CDFIs. So that's the sort of outline of the procurement structure. And now Lauren's going to talk through how the procurement could extend beyond nils.
Yeah, thanks, Georgia. And just for a moment, taking us beyond nils, we are thinking about other initiatives in the coming years that will support low-income customers. Likely from next year onwards, there will be other opportunities to pilot some new products that serve these customers, and where we at Fair4All and others will want to collaborate with lenders to really deliver this to the right customer groups. This could include pilots around tackling appliance poverty, helping customers in problem debt through consolidation loans, could be around financial resilience through savings and insurance for low-income customers, and also products designed specifically for different channels. So, for example, credit on price comparison websites. We're thinking about this and mention this now as part of the broader procurement scope, so you kind of have that future view in mind. But Kate will talk more about the kind of the current procurement scope.
Thanks very much, Lauren. So just to talk a little bit about procurement, which I know is everyone's favourite topic, particularly so early on a Tuesday morning, and my procurement colleague is perhaps the only one nodding violently, but do bear with us. In terms of procurement, we know that it takes a long time. So what we've done is essentially structured this procurement so that we can make the most of the time that we have to put in to procure the right lenders for the pilot, and that we can also be respectful of the amount of time that lenders will need to put in to their own bid submissions. So with that in mind, the pilot is basically going to run for 2 years of lending with a setup period and an evaluation period after it. And we're structuring the contracts so that they are capable of being extended, potentially up to a further 5 years in 1-year increments, which basically means that we'll be able to continue with nils if it proves successful and other funding come forwards. What we're also keen to do is make the most of the opportunity that we build with lenders through this procurement to make sure that we can use these contracts to test other products, which might also help people in vulnerable circumstances. So we're running with quite a large procurement envelope for the budget for this. It doesn't necessarily mean that we will let contracts at that maximum value, but it gives us the flexibility for this procurement to cover those potential extensions, both in the timetable for NILS and possibly scaling it up after it's been proven to work, and also for us to use those contracts for other pilots or other services. So what I'd like to just move on to now is that indicative budget envelope. And I appreciate the text is really small here, but just to reiterate, we're going to share with you in detail the market engagement pack, which I hope will make it somewhat more readable. But essentially what we're setting out here is the timetable that we're running with in terms of that initial setup period, 2 years worth of lending across 3 financial years. Those are public sector financial years. And then a post-pilot evaluation period with the option to extend in 1-year increments for up to 5 years for NILS. And then to also pilot other products and services through these contracts. Both the extension and our ability to pilot other products through these contracts are going to need to be agreed mutually with the lenders that we partner with. So this isn't a case where we can dictate that lenders must agree an extension or must sign up to deliver multiple other products, but we're really trying to make this procurement work for you and for us so that it has that flexibility built in. And we've got quite a large budget envelope here, which I mentioned. Again, our ability to use that is going to be dependent on other funding coming forward. So it's not the case that we're going to absorb the entirety of the Fair for All finance budget here, but we're building in that budget envelope if other funders come forward so that we can extend and use the funds in other ways. So I'd like to just move on now to talk a little bit about how we're going to make the fees work for lenders. So we're very conscious, as my colleagues have talked about, that NILS is expensive to run. We're targeting a group of customers who are somewhat harder to serve. We know that their situation can be quite precarious, and working with them to really improve their financial resilience takes time. So we've structured the fees to take into account what we think needs to be true to make it work for lenders. We've established a fixed implementation cost, which essentially gives lenders some funding to get set up to deliver NILS and enables them to be paid to work with us to refine the product as one of the first things that we do together. We're then proposing a loan processing fee, which will be paid for every loan that they make. And we've assumed that that's a higher cost to serve than might typically be the case for a normal commercial loan, taking into account the borrower's circumstances and how much support they're going to need through the customer journey. That loan processing fee also includes the charge for lenders to manage their participation in the pilot and to share with us the regular management information that we'll need to provide data and analytics, to come to workshops with us and to share with us their experiences of how it's going. Because as Sian said at the beginning, we really want to learn from this pilot and as we go to iterate through it. We've also got a bad debt guarantee provided by Treasury, and we've structured an outcome-based payment to make sure that there is an incentive for really great collections behaviour to try and get borrowers back onto a plan. And I'll come to a little bit more detail about those shortly. I also just wanted to be clear that although we've set out what we think are more generous unit costs for the loan processing for the NILS pilot initially, we'd expect to renegotiate those costs at the point that we extend the pilot, because by the end of the pilot period, we hope to have driven down the cost of delivery and optimised how to deliver NILS in the most efficient way possible. So just to unpack in a little bit more detail what the proposed fees and funding look like. I mentioned provisioning and the guarantee for bad debt. So we're really pleased to have Treasury's backing for this. And we know that it's really important for lenders not to have to take on risk for a product that they haven't yet tested. That's really the point of this pilot, to understand in much more detail what it takes to deliver NILS effectively and what kind of bad debt we can expect. And as you can imagine, it's really hard to estimate what that bad debt might look like. There are a range of examples across the world of NILS schemes with quite wide variation between them in terms of the bad debt encountered. We're anticipating that bad debt is probably going to be somewhere between 20 and 28% of loans issued under NILS, and Treasury have agreed to provide an 80% cover for the principal of those loans. We've then blended that with an outcome-based payment for the remaining 20% of the loan principal, and I'll come to that shortly. We also know that providing lending capital is important, and we're delighted to have the support of the devolved administrations and Fair for All Finance to provide the lending capital where it's needed across the 6 sites. We know that some credit unions are awash with capital at the moment and won't need that lending capital, but we are able to provide it to all lenders, irrespective of whether they're credit unions or CDFIs. So just to move on to a little bit more detail of the funding model and to talk about those other payments. So I mentioned the implementation fee. This is really designed to help us get going with lenders. We're not anticipating that lenders will need to make wholesale changes to their IT, but we do know that it takes time to integrate a new lending product into systems and processes. And as I said, we want them to be able to work with us to refine the product before we start. So we've made some assumptions about what a reasonable implementation cost might be, and it's our expectation that that will be a fixed fee. We're also expecting the unit cost for the loans to be a flat charge per loan. And as I said, the intention is that that covers the totality of the lender's support to the borrower across the customer journey, and also the management overhead in terms of covering how we look after those loans. Just moving into a little bit more detail on the outcome-based payments. As I said, Treasury have agreed with the bad debt guarantee to cover 80% of the principal for all loans. And our criteria for the loans that are covered by that guarantee essentially involves any loan that is within the NILS construct, which are provisioned at a 100%, or where the lender's existing provisioning policy has a loan not provisioned at 100% when they are referred through to CCJ or ELDS. We don't think it's particularly likely that either of those routes will be relevant to NILS, but we wanted to make sure that this was set up so that lenders' existing provisioning policies could be interpreted within the NILS construct. So those that 80% of the principal is covered through the bad debt guarantee. The remaining 20% of the principal is covered through an outcome-based payment. And the principle here is about making sure that there is an incentive for lenders to continue to work with borrowers who are in arrears and to try and get them back on plan. The outcome-based payment will only apply to loans which are in scope of the guarantee and will only be paid where we're seeing lenders meet some really key performance indicators about encouraging borrowers to get back on plan. That might involve a really empathetic collections process. It might involve some of the things that we talked about in the first webinar, like payment holidays, for example. But we know that it's a time-intensive process, and that's why we've put aside this separate budget for outcome-based payments. So that's the proposed fee structure. And in our market engagement pack, we will send out, we've got a series of questions for you about this and how it might work within your lending operations. Moving on to the delivery phasing, both Carl in his really useful summary of the timetable and Sian in her introduction in terms of the recap mentioned how important it is to us to learn as we go through the pilot. So what we've set out here is our plan around the phasing of delivery. We know that it's going to be really important to iterate both the design of the product, the processes that are being applied, and lots of the other experiential things that we learn from borrowers as we go. So it's our intention to have 3 waves of lending during this pilot. And between those waves of lending, we'll have a hiatus to pause, to reflect, to learn and to iterate. It's also a really crucial opportunity for us to monitor what's happening with bad debt. So in the chart we've got here, the blue bars show the 3 waves of lending. The orange line is showing the cumulative amount lent, and the grey line is showing our anticipated bad debt. We're thinking that we'll be looking to have about 3,000 loans delivered per location, and to make sure that we can start in a gentle way. It's our intention to begin with one lender initially, and then to have all 6 sites live by the end of the first wave. So that's our thinking in terms of the phasing. We've also made an assumption that most lenders' provisioning policies would lead them to have 100% provisioned a loan within 7 months. And you'll appreciate that those are quite big assumptions. So these are things that we really want to test with you during the market engagement, and the pack that we're sharing has a range of questions on it. Can I pass over to my colleague Tom to talk about what it is that we're wanting from you in the bid response?
Thanks, Kate. So in terms of the bid response, we appreciate that this is quite early days for this, but we thought it would be good to give you some visibility of the types of information that we'd like here. So clearly there's a response which will kind of detail out information on how you propose to deliver the scheme, and that's really the core part of it. That there's also a requirement for some technical elements, audited accounts and management accounts, and provisioning policy. We'd also like bidders to sign up for our Affordable Credit Code of Good Practice, which is published in our Transforming Affordable Credit report, and details out some of the kind of good practice that we see day to day out of community lenders. Then in terms of the due diligence, that there's a few elements which are kind of pass fail on assessment. So we'd like the lending entity delivering nils, whether that's part of a whole organization or the kind of entirety of an organization itself, to be either not-for-profit or asset and mission locked, to kind of ensure we're aligning to social purposes. We're seeking experience lending to borrowers in comparable circumstances, so probably on the riskier side, to nils borrowers. We're seeking financial sustainability from the lender, so that this is really important to ensure kind of continuity of delivery, and then operational sophistication to be able to kind of rapidly get up to speed and offer the nils product once we launch. So those are some of the kind of high level requirements, and we'll provide full instructions for potential bidders as a partnership in the tender pack. I've noticed, we'll get to questions, but I've noticed there's a couple about kind of the nature of I guess desired partnership between local delivery partners. From a bid point of view, we'd like there to be a lead bidder, essentially, so that Fair for All Finance and our delivery partnership has a kind of relationship with one bidding kind of entity, and that's all in one, as opposed to separate bids from separate delivery partners. I think the next slide is a bit more detail about our draft scoring criteria. I won't kind of drain this because it's quite detailed, and you'll get a chance to absorb this and see it in the pack. But essentially, we've tried to balance this across delivery, the alignment with customers, the partnership coming into the scheme, the ability to scale after the initial pilot, and also some of those technical elements about delivery, which will really kind of enable slit lending operations. So yeah, those are that's the scoring criteria, and you can see more detail of this in the pack that we'll publish. And is it Kate, back to you now?
Thanks very much, Tom. So just to cover out the contracting approach, we've a draft contract for services which we'll be issuing as part of the market engagement pack. And our intention here is to get feedback on it ahead of the procurement commencing. The rationale for doing that is that when we've appointed the lenders, we want to get going quickly, and we don't think it's realistic for us to be negotiating multiple contracts simultaneously at that mobilisation point. So we'll be sharing the contract at this early stage on the basis that we give people an opportunity to comment on that draft now. And at the point that bids are submitted, it's our expectation that the contract that is then refined and issued will be accepted as is. So the comments that we're looking for now are really important to help us shape and finalise that contract. And I think it's important just to reflect there is some room for us to refine it, but we're not expecting to make major changes to it. It's a contract that's in line with general public sector procurement principles and covers all of the typical arrangements that we have in place when we work with lenders. Some of you might notice that this is a contract for services, not a grant that I'm talking about, and that's also quite intentional. We're very conscious that this is something that we're asking lenders to do, which they are typically not currently doing, and that tips us into the territory for a contract for services. So I hope that's a helpful introduction to the contract. As I said, we'll share it with you as part of the market engagement pack and look forward to your comments on it. So what's next? Following the webinar, we'll be publishing the market engagement pack, the draft contract, a bit of a guide to that contract to help you interpret it, and a full pack of frequently asked questions covering everything that you've raised with us today and those questions raised in the first webinar. Really conscious that we haven't necessarily been able to do justice to both of those sets of questions, given that there are so many of them, which is fantastic, but those will come out to you in writing. We'd like your feedback on that pack by the 18th of October, and we're intending to then issue the invitation to tender in the middle of November. We know that lenders are really busy from November and over Christmas, so we've set out a much longer period for the tender process than is the norm. The public sector procurement regs require us to have a 30-day invitation to tender period, but we are intending to issue the tender in the middle of November with responses due in late January, just to allow both bidders and co-funders and referral partners to put together a really compelling bid. So I hope that's been a helpful session, and thank you all again for coming. I'm going to hand over to my colleague Tom, who's going to chair the next Q&A session.
Thanks, Kate. So we've got just about 18 minutes left, I think, and you've been really thoughtful with the questions that are coming through on the screen. We'll do our best to answer as many of them as possible on this call, but we'll also keep in mind the questions and publish answers to those that we don't get to, or those where we feel like we can provide a bit more detail following the session. So if we don't get to your question, please be assured that we've got it, and we will get to an answer for you at some point, either kind of in the follow-up materials or kind of individually. So I'll come around the team, and there's a few questions on kind of lending operations and the cost element of this, and perhaps if I could come to you first, Georgia, and then Kate on some of those.
Great. Yeah, so I've seen there are a couple of questions around kind of referral partners and kind of funding for referral partners. So I think kind of as we've outlined today, we've been working on plans, and we're bringing those plans to you today. And I think nothing's set in stone, so we're really looking for your feedback as part of this process. I think to date we haven't assumed that there'll be funding for referral partners, but if that's a kind of real deal breaker, then please let us know as part of that engagement feedback, and we'll absolutely take that into consideration. I think, yeah, as Tom kind of outlined earlier, we also hope that there are kind of benefits to those kind of funding and referral partners. So that's just something to kind of take into consideration. I think there are a couple of other questions as well, just around kind of the delivery costs for lenders and whether kind of admin costs would be covered. So I think Kate sort of outlined that kind of fee structure, but yes, we would absolutely be looking to cover kind of the setup and implementation costs. It's a kind of fixed fee structure, and you can find more detail about that in the pack. Again, these are kind of assumptions that we're really looking for your feedback on, so please let us know on the online form. I think in terms of kind of bad debt, that guarantee is kind of capped, and there's an outcome-based payment as well, which would be kind of triggered by certain kind of KPIs. And again, we're kind of working on an assumption that the bad debt will be between sort of 20 and 28%. So again, really looking for your feedback on those numbers. Shall I hand over now to Kate, who's going to answer some more of those questions?
Thanks, Georgia. So lots of really helpful questions, thank you. I've got a question here about dormant assets funding. So just to be clear, Fair for All Finance is funded through dormant assets funds. So our contribution to the pilot will be coming through dormant assets. I have another question about what type of lenders we're expecting to partner with, and will it be at a cost to lenders? So we're expecting to partner with lenders who have a great degree of experience lending to borrowers who present with similar challenges to NILS borrowers already. And that's likely to be affordable lenders, credit unions and CDFIs in particular. Tom highlighted in terms of the bid response that we're looking for lenders who meet our asset and mission lock. So really looking for those responsible lenders to come forward here. And in terms of the cost point, what we've tried to do in the fee structure is make sure that all of the lenders' costs are covered, but obviously keen to hear your feedback on that. And just to be clear, we've got a couple of questions about the guarantee and the outcome fee. So the bad debt guarantee applies irrespective of whether we're providing the lending capital centrally or whether that's being provided by the lender itself. And we've also got a question about the 20% outcome fee. It's our expectation that that fee will be triggered by particular KPIs being met, and it will be up to a maximum of 20% of the loan principal. So the combination of the 80% of the loan principal covered through the guarantee and 20% of the loan principal covered through the outcome-based payment is how we've tried to structure it to cover all of the risk side of the costs. And then the unit cost for loan processing and the setup fee are how we're trying to cover the lender's other costs. I hope that's helpful.
Thanks, Kate. That's great. We've also got a set of questions around kind of the nature of the partnership setup, but I might just take a couple around there. So there's one around have potential co-funders confirm their intention to support and who is expected to engage with the potential co-funders, lenders or Fair for All Finance. So we've had a couple of good early conversations with co-funders, but from a local point of view, we would like lenders and co-funders to come together and have conversations about whether this is something that they can do jointly and bring different elements to it. So that being the co-funding element, the lending operations element, and the referral element. We don't think it needs Fair for All Finance to be part of those conversations. In fact, it would probably make them less fruitful and kind of hold them up. So we would like to encourage bids from sets of organisations and for organisations themselves to have a conversation about whether they should come into this jointly. And as we said during the call, there'll be an opportunity in the online form that we put out with the market engagement to indicate that you're interested in partnerships in a local place, and if there's applicability there for kind of several partners in the same place, we will try and kind of match those together if you express willingness to be matched there. There's a specific question about housing associations and whether a housing association could be involved in more than one bid. I think yes, essentially. We know that some housing associations operate across large parts of the country. In those cases, it might be that two areas have kind of some housing stock with one provider. In those cases, that would be totally fine to see those bids come in with a housing association in multiple ones, or indeed if the housing association is the lead bidder and wants to put in from multiple locations and bring lenders on board in each of those locations, or that can operate across the locations, then that would be a good way to do it as well. And I'll just take one more here. Are there no advice agencies included? We deliberately didn't explicitly state advice agencies because we know that advice agencies typically don't have a credit brokering exemption or license. However, we know that advice agencies are on the front line and identifying need all the time, and if any do have the relationships and permissions such that they can refer into a credit product, then we would really welcome their applications. I might move on to a couple of questions around the product space now. And Lauren and Carl, I wonder if between you could pick those up, please.
Sure. Shall I go first? So yeah, a few good questions about products. What I'd caveat them all by starting to say is product design is one of the areas that both Carl and I are working closely on, but we also, that is an iterative process, collaborative, both with customers, the end users of the product, and with lenders as we go through the process. So where there's questions about minimum, maximum amounts, durations of terms, we do have some kind of working assumptions to start with, but that could vary as we go through the process. There was a specific question around will the loans be ring fenced for certain needs? Our starting assumption is that loans will be paid directly to the customers for a range of needs, starting with a range of needs probably in line with what lenders are already doing today, and that's what we want to learn more about. But the loans will be paid directly in line with that, and not to not to someone else. Carl, I don't know if there's anything you'd want to add to that.
Not on that specific question. I was going to say about the affordability question that there's no working assumption that we'll be working with or we'll be moving people who have used a no interest loan scheme onto a higher cost lender. In the higher cost lender in the question is the CDFI rather than the credit union. But our working assumption is that someone who is using a no interest loan scheme will be using it on the basis that over time they will become eligible for a reasonable interest bearing loan, and the no interest loan scheme acts as a kind of buffer space for that person to become eligible for those more typical loans from a CDFI or credit union. But we've got no preference as to whether that person moves over to a CDFI or a credit union. It's just simply whatever is the best loan product for them after the period that they've used the no interest loan scheme.
Thanks, Carl and Lauren. That's great. There's a few questions in there about particularly timelines and where we've given what consideration we've given to the formation of local partnerships and a few details there. Kate, could I come to you on those, please?
Happy to take those, thanks, Tom. So in terms of timeframes, there's been a comment about needing some time to come to decisions and create relationships with local authorities and joint partners. Just to be really clear, we've got a deadline for feedback on the market engagement pack of the 18th of October, and that's going to help shape our thinking. But the tender responses are not due until late January. So we think there's plenty of time for those collaborative conversations to take place. And we're really happy to try and help introduce parties to each other if that's a useful role for us to play. We've also got a bit of a question about whether we can have responses from lenders who combine with another lender to cover a wider geography. And we're certainly open to that. So happy to take a really specific question offline if someone wants to kind of tease that out in their feedback to us on the market engagement pack. The only thing I just reflect there is that in terms of the pilot, we're talking about 3,000 loans per location. So we want to make sure that sort of makes sense in terms of the geography that's being proposed. But the sort of flexibility around the geography is why we put that lotting structure together, so that lenders could be thinking about bidding for one or more locations in terms of the lots that we've suggested. So I hope that's helpful.
Thanks, Kay. That's great. Well, as you can see, we're trying to kind of group these together and handle as many as possible. There will be ones that we miss, but we will cover those after the call in the follow-up materials. So apologies if we don't get to your question, but we will cover it. Sean, there's a couple of questions about the kind of specificity of delivery for kind of customers, and also who can be a lender partner. Could you come in on those, please?
Sure. So you're hearing all the time that we're saying this is iterative, and we're still developing both the product and the product requirements, and also the terms of lending. So everything we're saying today is our kind of beginning assumptions, and we're looking for your feedback. So first of all, we're thinking about whether one customer can apply for more than one loan. At the moment, we're thinking about a 2-year timeframe for the lending pilot. So getting someone cycled through a couple of times could be challenging, because we think that one of the factors around NILS being helpful for people is having a longer time to repay. So the likelihood of getting someone through more than one loan in a 2-year pilot is probably quite low. At the moment, our assumption is that we're open to thinking about that, but we're not kind of hard baking it in. So we'd like your feedback on that. And then in terms of who can be a lender, so you heard Kate say that in the pilot, we are definitely going for lenders who are essentially going to meet Fair for All Finance's mission and asset lock. So if you've got any questions about whether you as a lender would comply with that, please go to one, look at the pack, and two, if you're not sure, then ask us directly and we can talk to see, could we find a way to make you eligible? And maybe the answer is no in the pilot, but that doesn't mean that you couldn't, for example, be a co-funder, or it doesn't mean that you couldn't think about being part of the wider scale up. But as we say, all of this is open to kind of discussion, so come and ask directly. And I think someone also asked if you can directly talk to the Fair for All Finance team. Absolutely, kind of put your questions in, it'll all be in the pack about how to do that.
Thank you, Sean, that's really helpful. And just to emphasize on that question of can a bank be part of this, we're looking at multiple options for the scale up of the NILS scheme, and for us it would be great if a bank saw this as compelling for their customers, such that they were willing to kind of take it on in the long term. So we'd be really happy to have discussions about that. I think that's about all we've got time for in terms of questions. And as I said, we'll get back to those that we didn't get a chance to answer on this call in the follow-up materials. But hopefully we've clarified a few of the pressing points here. And with a couple of minutes left, Kate, could I hand back to you for the kind of wrap up?
Thanks, Tom. Just to finish by saying thank you again. We've been really delighted by the response that we've had thus far, and you've asked many really stimulating and thoughtful questions this morning. So I really appreciate you coming along, and also to those who also attended the first webinar. We're really excited by the prospect of NILS, and we think that together we can make a real difference through it. So we hope to work with you really closely to achieve that, and look forward to your responses to the market engagement pack. As Sean pointed out, we're really happy to take separate questions. So in that pack, we'll be sharing questions for you, the slides, the frequently asked questions, and the draft contract, along with our contact details if there's anything that you want to come and contact us about separately. So all that's left for me to say is thank you again, and we look forward to hearing from you in terms of the market engagement feedback.